Hello and welcome to this Friday's morning markets briefing. We've got a lot to talk about, but firstly, German inflation rises to 3.8% in blow to rate cut hopes, as well as that the Houthi rebels defy US warning with new Red Sea explosion. We've got a lot to talk about on the charts, also with lots happening on the economic calendar. We'll come to that near the end, so make sure you stay around so you can see that. Before we get straight into it, make sure you subscribe. But the first article to talk about, of course, is German inflation. Now, inflation in Germany rose by 3.8% in December, up from 2.3% a month earlier, with this casting doubts over hopes that the ECB will start cutting interest rates soon. Now, when we did cover this initial last month's figure of 2.3% for inflation, it did come as a massive surprise for the markets, with this kind of spawning a very much kind of optimistic, dovish view on the markets, especially for the Eurozone inflation, as well as the kind of ECB interest rate, as we do know that the Eurozone as a whole has been struggling greatly during this high interest rate period, which these leading Western economies have been experiencing recently, coming out of COVID and the issues associated with that. But ultimately, the Eurozone has been an economy which has been hurt more than others, and having high interest rates has damaged other economies more than most. And the Italian economy, being one of those, specifically to note, where we have seen kind of issues arise between the political leaders of Italy, Giorgio Meloni, between the ECB, so the central bank of the Eurozone, and the kind of conflict between those two figures as a result of these high interest rates during a period which is very hard for most economies within Europe and the Eurozone as a whole. As a result, many were kind of looking to this low inflation rate that we did see last month as something that was very positive, optimistic, and beneficial to the German economy and other Eurozone economies, as this would see interest rates finally come down. But it does seem that inflation is once again back up, and this seems to be once again proof to why the ECB and other central banks want to focus on the core inflation rate rather than the nominal inflation rate figure. As we'll come to near the end of this article, the key reason why inflation has ticked up so significantly this month in comparison to last. Now, the cut in subsidies on gas, electricity and food had triggered the resurgence of inflation, with German energy prices rising 4.1% in year on year in December, up from minus 4.5% in November. And this is key and very important to note, of course, because the core inflation rate figure does, of course, exclude the very, very volatile prices of energy and food. And this is the key figure which the ECB in this question does tend to ignore and cut out and follow the core inflation. I'm not sure whether I articulated that right, but it really is the core inflation rate figure that they follow as a result, because it does exclude those more volatile items such as energy, which here we can see is causing that increase in inflation in comparison to that large drop in inflation that we did see last month. And so, it does make sense to why they're focusing on that core inflation figure. Now, French inflation figures mirrored those in Germany, with inflation rising 4.1% compared to the 3.9% figure in November, which once again represented price growth for energy. Now, price growth in the Eurozone has been nearing the ECB's 2% target, leading those to expect low rate cuts sooner than previously expected, and as a result, causing that bond market and equity market rally that we did see, towards the end of last year. And this was not only within the Eurozone. Just yesterday, we spoke about the great kind of US equity rally that we did see ending off last year as a result of the Fed's more dovish comments, and it's been similar comments and similar data within the Eurozone, which has allowed for the German and other Eurozone equities to rally. And so it's quite interesting to see, or it will be interesting to see, how this inflation figure now does impact, the rallies that we did see ending off last year in the Eurozone, just because of how key the German economy is, and having that inflation figure rise to 3.8% does put, a kind of does dampen the kind of optimistic feelings which most were having about, rate cuts coming soon. Now, Eurozone inflation rate figures are set to release on Friday, but are expected to show a rise in inflation from 2.4% in November to 3% in December, ending 6 months of falling prices. Now, that's very key, as well as, of course, Germany is the leading economy within the Eurozone, but ultimately we need to be looking at the Eurozone inflation figure as a whole, as there are very large differences in the inflation figures that we're seeing from country to country within the Eurozone. So it is important to get that overall figure, but it does seem that, and kind of no surprise considering the German economy is the strongest economy or most influential within the Eurozone, we are expecting a similar jump in inflation to one that we did see with Germany, going from 2.4% in November to 3% in December year on year. Following the higher than expected inflation rate figure, following the higher than expected inflation rate figure, held the euro, it was cut out in my notes. The euro held on to gains and bond prices stayed lower, with the 10-year yield up 0.09% at 2.12%. So, that's very important to note as well, that the euro, despite this figure, despite this maybe, pushing a more hawkish message to the markets, we are still seeing the euro hold on to its gains that we did see. So that's something that's interesting to note. I mean, of course, a more hawkish monetary policy is more likely to, call for strength on the euro, let's say, in reference to the ECB. But ultimately, as we'll come to in a second, it does seem that core inflation figure, inflation rate figure, is one that could be coming down, with some referencing the more significant core inflation rate figure, which continued to fall. So that's the important and interesting thing to note, is that the euro's held on to its gains despite the core inflation rate figure coming down. And we do know that the ECB uses the core inflation rate figure far more than they use just the normal nominal inflation rate figure. But the ECB has already made clear that expectations that inflation in Q1 of 2024 would be around 2.9%, which is up from 2.8% seen in Q4 of 2023. So definitely keep your eyes on this. Very significant news and data surrounding Germany and the Eurozone economy as a whole. So keep your eyes on this. Next to talk about, though, is the Houthi rebels. Now, yesterday, Houthi militants detonated a surface vessel in the Red Sea in an act of defiance. This blast did not damage any ships, but occurred despite the US and its allies warning the Houthis of military action unless they stopped attacking vessels in the Red Sea. Now, this has been a very important topic that I think that we've kept on coming back to, and that is ultimately because if this does escalate into somewhat of a regional conflict, we could see dramatic effects on a wide range of markets. It only takes a second to go and look at the gold markets during the period of first, the Russian invasion into Ukraine, and then the period of the Hamas attack into Israel and the conflict which ensued from that. And if you just look on the gold market during those periods, you see a dramatic spike to the upside, and that's to no surprise, as these conflicts, not only are they kind of the investors look for safe haven assets such as gold, during these times of crisis where they know that they will always have value in gold, but also the risk of conflict does, always have that risk of escalating further, bringing in more parties. For example, if the US somehow got involved, that could dramatically affect the dollar, create lots of government spending, damage the dollar, and that sort of thing. And so gold and other assets such as oil, especially in the case of regional conflict in the Middle East, all are very important to keep your eyes on in these times. And so that's why we definitely need to keep on coming back to this kind of new news in relation to it, as escalations are likely, and any escalations, of course, are dramatically going to affect markets. With this act by the Houthis heightening regional tensions further, as the likelihood for the regional war only grows, with strikes in Beirut and Baghdad taking out senior military leaders for both Hamas and Hezbollah. Now, we did talk about, maybe yesterday or the day before, we did talk about how Israel had taken out a senior Hamas leader within Beirut, Lebanon, of course. Now, Lebanon is largely influenced by the militant group, also funded by Iran. Hezbollah, we know this is a very powerful military organization, which Israel has already vowed previously to eradicate, but we're not sure on when that might happen. But we've heard similar calls from the Houthis and Hamas and Hezbollah as well. And now we're seeing, the US and Israel strike leaders in Iraq, and now again in Lebanon, striking this time a Hezbollah leader. The chance of escalation are only growing. With these strikes on leaders, whilst it may disrupt military planning, which may be taking place, ultimately it will cause retaliatory strikes, and this can only cause further escalation. So this is the key issue at the moment, is whether this escalates further, and the worry is that it will. Now, the Houthis have recently engaged in 25 attacks on merchant vessels in the Red Sea, with more than 20 nations now joining the task force to oppose Hezbollah's attacks in the Red Sea, with the US, UK and France all sending warships into the area. But the Houthis have said that they will not stop their fight unless Israel concludes its offensive into Gaza against Hamas. Now, this is something which Israel is very unlikely to do, seen as Israel seems committed on eradicating Hamas from Gaza. And as a result, of course, we're likely to see the Houthis continue their attacks within the Red Sea despite the Western deterrence. Now, the Biden administration has recently blamed Iran for the Houthi attacks in the Red Sea, and officials have also said that they aren't looking to widen the Israel-Hamas conflict, but the risks still remain that the war between Israel and Hamas could become a regional one. So this is very important to keep your eyes on. Definitely keep your eyes on the oil, gold and US equities markets as we kind of see whether this conflict does escalate. Those will be dramatically affected. Those markets, will be dramatically affected if this does escalate further. So definitely keep your eyes on those. That's all to talk about on this article and the articles as a whole. Next to talk about, of course, though, is the charts, where we do have quite a bit to say. Now, firstly, on US indices and the US 30 in particular, we are seeing US indices continue to hold and kind of consolidate, really. And here we do have the US 30. And as you can see here, since the end of December, really, we have just seen this continued lack of momentum and volatility on the US 30. What will be interesting to see, though, is how the markets do react to the NFP figure that we are getting today. Obviously, non-farm payrolls are very influential to the Fed's monetary policy and highly influence the way that investors perceive the way monetary policy will be set, and therefore understanding the US's unemployment and employment figures is always important to understanding where markets may go. So this will be very important, to keep your eyes on, and will be, and the markets will be highly reactive to any news in relation to that. So keep your eyes on the US 30, but also listen out for any news around that. I just want to adjust this real quick to highlight the possible areas which price could retrace to, as it does seem like it's kind of moving slowly to the downside. So maybe it will retrace to one of these key levels. That's all to talk about on the US 30. Next to talk about is the dollar. And the dollar has come up and tapped this key liquidity zone, and the double top that we had previously mentioned. Interesting to note though, we haven't seen a significant bearish move away from that area. In fact, we've only just seen price come up to it, tap it, and now it's consolidating just underneath. So we could still have that bullish momentum which has pushed price all the way up to that level. But once again, as we spoke about in the US 30, the NFP figure today will be very important to understanding where the dollar may go from here. It does seem that banks and other financial institutions, of course, have got in their sell orders and sell hedges around that double top level and liquidity zone that we did highlight going into the NFP figure today. So look out for how the dollar does move and react to the key NFP figure. That's all to talk about on the dollar. Next to talk about is Euro USD, which like the dollar and mirroring the dollar, did react with that double bottom level and key liquidity zone. Once again, like the dollar though, it's failed to gain any strength, and once again it will be interesting to see how price does react to the NFP figure today. I think that largely though, the reason why we are seeing a bit more strength on the euro than we are seeing bearish momentum on the dollar is because of that German inflation rate figure that we did get yesterday, which is influencing and making it seem like the ECB will be forced into a far more hawkish position with their monetary policy. That's all to talk about on the euro though. Pound yen next to talk about, and interestingly enough for pound yen, we are now reaching the top of this range that we have kind of highlighted. It'll be interesting to see whether we once again react to this level. We've reacted with it twice before. We're kind of forming a new range, a new period on pound yen at the moment. That's very different to the kind of upward trend that we were seeing between October and the end of November. And going into the new year, we're really trying to decipher where pound yen may move. We obviously had that great deal of yen volatility which drove pound yen to the downside, and now we're in this range. So we're really just trying to work out where pound yen is sitting in the market. So keep your eyes on this. Next to talk about though is Bitcoin, which yesterday we obviously did mention had taken a significant crash or move to the downside, breaking once again back below and into this range that we had seen price move around in after breaking out, and price had broken out, but had now returned back into that range. Now price smashed through the 78.60, which you would expect price to maybe react to, but once again no body of a candle did close below that 78.60, so maybe liquidity was just gained from that zone, and we did see price move to the upside going into today, and now price is sitting around that 61.80 that I've drawn out. And so the question is whether we will now stay in this range that we did exit from a day or two ago, or will we now continue this push to the upside and break out of this range and liquidity zone that price is currently sitting in. So definitely keep your eyes on Bitcoin. Next to talk about though is gold, which in reference to, of course, all the kind of world tensions that we're experiencing at the moment, gold is the one to keep your eyes on. So definitely keep your eyes on gold. As the chance of regional escalation within the Middle East are heightening. So that's something that's very, very important to note, and definitely keep your eyes on gold. We did move away from that 50% Fibonacci level and liquidity zone, but we haven't seen too much significant momentum to the upside once we've reached that area. That said, we're getting the NFP figure today as well, so maybe that will have a great deal of effect on gold. We just don't know, so keep your eyes on that. Lastly to talk about on the charts is oil, which is kind of just bouncing around. It did react with this questionable level of liquidity that we did highlight yesterday, but how key that area is, we really don't know. It does seem though that we are now forming a bit more of a bearish trend. Whether we can actually reach the very bottom of the market though, it'll be interesting to see. Of course, the tensions in the Middle East will be highly, will cause oil to move in very interesting ways, especially if Hezbollah now do invade Israel, or the US and UK and other allies do get involved with the Houthis in Yemen. So keep your eyes on these topics most certainly. That's all to talk about on the charts though. Lastly, to talk about, of course, is the economic calendar, where we do have quite a bit of data coming out today. Now, firstly, we will be getting Japanese consumer confidence, as well as that we're getting German and Swiss retail sales data, so very important to note. As well as that, and one of the most important data points today will be a Eurozone inflation rate figure. So of course we have already spoken about that on the articles, but ultimately it will be interesting to see what we get on that. Obviously the core inflation rate figure is the more important one, and we are expecting a decline in the core inflation rate figure, so keep your eyes on this. Next, we will be getting Italian inflation rate figure. So, once again, another Eurozone inflation rate figure. And then along with that, we're getting Spanish consumer confidence and business confidence figure. Important to note, of course. And to end it off, we will be getting Canadian unemployment rate figures and the US NFP and unemployment rate figure. So very important data that is, and listen out for all of it. Keep your eyes on the charts, and I hope you have a great trading day. But that's all from us at Wildwood Capital. Have a great one. See you later. Bye.